Hey guys, welcome back. As always, this is not financial advice. This is for educational purposes only. I'm sharing how I'm reading the market, what I'm watching, and how I'm thinking about my trades. So today, here's the setup, the quick setup. We were down. It started off as a rotation day, but the indexes were mostly lower by the close. And the real story was what was underneath the surface. Semis held up better. Software got hit hard. Energy caught a bid. Space stocks reversed lower. Crypto weakened even further. And the market is starting to care again about inflation pressure, labor data, and whether AI infrastructure spending is actually going to justify these valuations. And we also got that important macro data, which I was talking about yesterday, ADP, private employment. ADP showed that private employers added about 122,000 jobs in May, and ISM services came in strong at 54.5, but the prices component was hot, which means that the services economy is still expanding, but the inflation pressure is not gone. So that's why it felt kind of mixed today. So growth isn't dead and AI is not dead, but the market is starting to rotate and question which parts of the trade are overextended. And even that rotation is starting to feel a little weak. Here's the heat map. So let's start with the indices. I'm going to go through sectors today thereafter. Thanks for the suggestion. So SPY, I have it up there. It's down 0.7%, almost 1%. And there's also something going on in the after hours right now, which is Broadcom reporting. So I will... I can't type it in. I'll talk about that later, but it's getting hit for sure. And I got to go through the report and figure out everything. But we knew this was probably going to happen to the stocks eventually. But anyway, the SPY was down 0.7% during regular trading, and that tells me that the S&P is still near highs, but it's not immune to the rotation. And the broad market was pressured by weakness in financials, communication services, discretionary software, and then QQQ. It also outperformed it. It was just down 0.26%, whereas SPY was down 0.7%. And again, that probably has to do with the semis. But it's interesting because when it holds up clean above SPY, that's also a signal for me to check out the constituents. And we're going to break that down when we look at some of the individual names. The Dow was also down, but it was down by more. It was weaker than QQQ and SPY. It was down 1.13%. So it didn't really provide the same kind of defense support today that it did yesterday. So financial and industrials weren't strong enough to offset the broader pressure. And a lot of people I know are watching financials as a signal, including, and I know this isn't true financials, but a lot of people are thinking Bitcoin is a leading indicator. And so it's an interesting thing to think about, particularly because we've had a dump in for like the better part of the last week, maybe 2 weeks, really. And let's look at IWM here. So that was down 1.137%. So it's the weakest of all of them, I believe. And that's important because small caps are usually where I look for risk appetite. And when IWM is lagging while semis are still holding up, it tells me that, again, this isn't broad animal spirits. It's narrow, selective market. And I think everybody's feeling that way. I mean, your portfolio might not be doing amazing unless you are in semis for the most part. And even then, if you were just holding NVDA and hoping to ride it, you'd be disappointed here. So the market's not falling apart, but the risk on trade is getting more selective. And I'm going to go through the sector reviews, and then I'll give you some of that market sentiment read as one of our viewers requested. So XLK, we can start there. So it was lower today. I mean, this chart is pumping, and we kind of have equal highs there. Ooh, actually, it may be an engulfer slightly, at least on the body of the candle. Either way, it's not completely falling apart, and people get chopped up trying to trade these hanging men. But in general, it was lower, and it's odd because the semis were stronger. But the issue is that tech is not one single trade. So software and mega cap tech were weak, while semiconductor infrastructure held up better. And so speaking of that, let's go into the semis. So I don't always just do SOX to look at it. I spread it around because it's a hot trade right now. So SOXL, which is the 3 times leveraged ETF, and then SOXS, which is the inverse of that, and then the actual SOX. But then I look at SMH a lot because of how many options are trading on it. And what I've noticed here is something very interesting, which has to do with the gamma on those, because everybody's waiting for this trade to fall apart, including myself. I've been hedging using SOX S, which you have to be very careful. I could do a whole episode on leveraged ETFs and when to use them. So let me know if you guys would want to do that. But don't go into these things unless you really know what you're doing. I mean, if you, again, not financial advice, but one shouldn't consider going into these without really understanding what they are. So if you had just bought it way back in the day, you would think that you were a genius on trading that. But let me tell you, they don't always work out that way. But at this point, this isn't a terrible instrument from a downside to upside. Although it is worth noting, when most people look at SOX-S, they think that we're going to climb back up to 240. But there's many stock splits that happen. So they do that to keep the price from going so low. So this has all been adjusted there. So don't think that there's unlimited upside to it. However, if you were going to play the inverse of SOXL or SOX or SMH, that might be a good trade to start building out shares, especially because it trades 24/7, and we're seeing some stuff going on in the overnight. So it's a trade I really like, and I play it from time to time, and sometimes it really rewards you. Other times it's just like the semis, but we'll go into what I'm thinking about the semis in general, but I do think it's time to be considering that, and I have been putting on a hedge, and I'll get into that again in the market sentiment read. But when we're looking at the semis here, I look at the gamma of all of these related indices and ETF products that are made to trade the indices. And what's interesting is SOXL, which is like, again, it's because it's leveraged, that's where you're getting a lot of the FOMO retail trade going. So I look at that to look at the call activity, and it is pretty aggressive towards the upside, targeting about 300. And then, but when I look at, I haven't loaded it yet. When we look at SMH here, let's get a single read on that real quick. And again, just to explain how these are working, this is the first week, this is the first month, and this is all expirations. I can actually change that if I want, but this is what I want to see. I want to see basically the near term, the medium term, and the longer term, and compare the information. But what I'm going to show you now is that SMH doesn't reflect the same setup, which is more problematic to me than it would insist. So here's the SMH, and we have tons of negative gamma at the 550 line, which is the gamma flip line. So SMH, 550 makes a whole lot of sense. It would probably have been this consolidation / accumulation range here. So it falling down to there isn't the craziest thing, in my opinion. And that's just by the end of the week. And whether that's actually the target or not, some of the GEX data is suggesting that, also with a few other things I'll talk about in the market sentiment section of this video. Next, we have IGV, because this has been an interesting trade, and it pulled back today a lot. You know, it was one of the bigger problem areas today. It got hit after that recent explosion higher, and you know, it's the exact group I'm watching because the market recently shifted from AI destroys software to AI helps software, but today was a test. You know, this in general was down, but also some of the stocks I've been watching, like now, Asana, Path, Microsoft, they've all come down quite a bit. Although we're seeing something here that I want to talk about coming up. So moving on to XLC, you know, communication services were weak. This is where Google and Meta matter, and Google is still dealing with the AI CapEx and capital raising concerns. So it's down about 1%, not as bad as yesterday. And Meta is trying to stabilize, but it had a really nice move today. We went in on some long calls yesterday at the close because, as I said in yesterday's video, we were just holding the 600 so well that it seemed like a good time to take a risk-adjusted position on that. So let's look at XLY next. So XLY, what do we got? You know, it was lower, and it's important because financials, as I mentioned earlier, I'm sorry, not financials, XLY, here we go. So that fits with Amazon being lower today. So if you look at what happened there, I mean, it really took a bath there, and the market not really rewarding discretionary growth today. And when XLY is weak, I don't want to pretend the consumer side of the market is confirming the risk on trade. And, you know, I think this is totally normal. We can get to individual names later, but that's the kind of pullback that doesn't really worry me if you're looking at on the weekly. This trend is just really quite nice. But it's not something I'm YOLOing into. And so let's look at XLF, like I was talking about preemptively here. So it was lower, and it's important because financials you know, financials in general, like a stronger economic read. But if inflation pressure and rates are a concern, the setup becomes more complicated. So again, it wasn't another day. Today was not a day that had, you know, the banks leading the market. So XLV, next, healthcare, it was positive. You know, it was up 0.79%, getting close to a 1% there. And The interesting thing about XLV was that it acted like more like, its defensive nature today. And that tells me some of the money was rotating into steadier areas while high beta software and crypto names kind of cooled off. And XLE next, energy was strong. Oil was up and energy caught a bid, which also explains some of the weakness in some of the other indices. And I touched on this yesterday when XLE is outperforming the other indices, SPY and QQQ, but particularly SPY is really what I'm looking at. Then I know that we might have a pullback coming. Not even know, but just to start considering it. And again, I'll get into the market sentiment there. Let's look at XLP next. And XLP is something I've been thinking about a lot just because of what I said about people rotating in XLV. It's staples and it was up slightly higher, and it's another defensive signal. Not huge, but when staples and healthcare are working while software is selling off, I definitely pay attention. And you may have seen in some of my other videos, I have some huge positions, or not even huge, but I have a number of positions that are reasonably sized in some of the XLP, including I got Campbell's yesterday. CPB. For that very reason. And these are consolidating down there. And I don't want to get into single names yet, but actually in the comments, let me know if you want to hear single names while I'm doing sectors. That would be very interesting to me if that format is better, because I am trying to dial these in and have a much cleaner presentation for you. And I think that going sector by sector after indices is probably a good start on that, but let me know. XLU next. So XLU was lower today, but it's still a sector I'm watching closely. After yesterday's drop, it looks like it is consolidating down there. Basically, this really long daily point of control. So I'm not scared by this, but this isn't a big name that I'm playing anyway. But something to look at, especially because they can trade like defensive rate sensitive stocks, but they can also trade like AI power demand beneficiaries. So today they didn't lead, but the AI electricity theme is still alive. And so if we actually looked into the holdings there, it would probably, clarify a lot of that a little bit better. So XLRE, it's been an interesting one to me. So to be honest, it was basically flat, and that tells me real estate isn't the main story, and it's rate sensitive. So I'm still mostly watching TLT and yields to understand where this group goes next. But I also really do like this consolidation here. We had some of this consolidation blast up to the next level, came back and tested it, came up, consolidated. And I do think it is ready for something, but I will say this isn't something that I play directly. In one of my portfolios, I'm holding a lot of IYRI and getting ready to make another big position on that because I treat real estate as income instead of owning properties. I am owning IYRI, collecting rent in that form and not having to deal with being a landlord. Again, not financial advice, just telling you what I'm doing in the markets. So let's look at XLB next. Go to a different portfolio here. So materials was slightly positive, and that fits with the commodity and inflation sensitive areas holding up better than software. Let me go back to intraday here. Also, that's another thing. Please let me know in the comments if you'd like to see these charts on both intraday and daily as I'm figuring it out. The best way to provide this information at the end of the day. So XLB was slightly positive, and like I said, it fits with commodity inflation sensitive areas holding up. And so overall, like all of these sectors I just went through, and let me know if you want to see others, because going through the State Street ones is cool, but as you saw, even when I go through SMH, I'm diverging from the strict sector ETFs. But the takeaway today is the market's very selective. Energy, healthcare, staples, materials, and semis held up better, but I also see that as rotation. And software and communication services, discretionary financials were weaker, which isn't a surprise if you actually are thinking about this from a rotation situation. We had a huge, and this is where going back to the daily really helps, especially if I turn off extended hours trading here. So let me turn off that. You can really see like IGV had so many gaps up there, and I can, when I do daily extended, doesn't matter. But if we do something intraday, just the way that this had been working, with blasts up and gaps off, coming back to the 200 and around the psychological number like 100, IGV makes sense that it would be pulling back, including its holdings, and people would be looking where else to rotate. In fact, I actually think that's healthy, even though my thesis we're about to get into about the actual market sentiment and how I deal with reading it, because one of the commenters on a number of videos, Fixator, give you a shout out there, has been mentioning that, how do I read this considering we're really overbought? And here's what I'm watching. So I'm watching breadth, of course. And so when the index is, and there's a lot of ways to watch breadth. I could do a video on you for that. People use the McClellan oscillator. You can also, individually track them based on how you want to identify breadth. So comparing sectors for sure, but also checking out how many stocks are above certain moving averages is also something that you can see on the charts. But a real quick way is some of those sector versus sector things, or even just a real quick back of the hand or back of the envelope math that I was doing with IWM versus SPY. So when indexes are near highs but IWM is weak, it starts to tell me that the rally is not quite as broad. And I don't mean it's falling apart, but it's not quite as strong. And there's a number of other things that we can look at besides just breadth. Yesterday's rally looked exciting, but we're taking a pullback here. But on SPY, and I mentioned this yesterday, because, there's the first thing what I'm saying is we ran yesterday and we pulled back. That is just normal market function. But if we're thinking of this in the context of normal market functions, we've gone 20% in about 3 months, less than 3 months, like 2 months, right? 2.5 months, something like that is 330 to 68. So, or to the third. Wow. Okay. So yeah, we've gone about 20% there. We're historic levels away from the 200 simple moving average. It tells me that I need to start to be thinking about catalysts. And the way that I do that is I start marking out all of my bearish indicators. Oversold is one thing, but what I really like to look for is a series of divergences on the RSI. So I marked out this one yesterday, but I also have one over here that we saw earlier, and you can see the price is going up and the RSI is going down, not essentially going down, but not making new highs. But some people will see this as a different type of pattern, but we'll get to that. This is why you do multiple of them, because you start to see a pattern emerging. And even here we got one, and then it started to pull back. I mentioned in my video yesterday that I hedged it. And so maybe the question from Fixator was, how do you actually go about and implement this? And so for me personally, again, this is not financial advice. This is what I'm doing in my own portfolio. And I do some very quantitative things, meaning I calculate the total beta of all of my holdings and see what type of protection I need. And I also start to do some type of correlation assessment to see if my holdings are truly orthogonal or not, meaning are they related? Are they have a vector that they share? And if I assess that I am not at a huge risk, I will hedge lightly, and also looks at my full market outlook for the year. And actually, maybe let me explain that one more time here, where I think about the expected moves for the year. And when we have such a risk-on thing going on like this, looking at QQQ is better, even if I will start to hedge on the SPY because I'm happen to be more allocated to things that move in tandem, they're more correlated to the SPY, right? That's what I'm using for my beta, not QQQ, at least in this portfolio. And essentially, I marked out the expected moves for the year. January 1st, I looked at the options change and calculated what are the expected moves for the year. And I could do a video on how you do that, but I had come to the conclusion that 748 was the expected move for the year. And if we also look here, I didn't mark it out, that we have the same divergence that we saw. So what day was this? Go from the close to the close of today. Or actually it was from yesterday, but that would have been the high. It's roughly the same thing. Let's actually just, we can edit that line by, or let's delete it. Sorry to waste your time on that. Let's actually, Thinkorswim is having a little goofy problem there. Let me see if I can get a click on it. There we go. Okay. So from yesterday's close. Okay. Sorry about that. So essentially, I was hitting the daily expected move at the exact same time that we have an RSI divergence here, a bearish divergence for me. So that's when I start putting, or just at least checking my ratios and making sure that I'm hedged well enough. And another thing I started hedging, as I mentioned to you, was SOX-S, which is the inverse. And I'm going to need to put back on extended hours here on my equities, show extended hours, apply that. And you can see we're getting a huge pop there. And that's probably just because of AVGO. Oh, that's bringing it down. But, you know, even if I didn't know about that, just based on the fundamentals here, because the way that I think about it is that bearish divergence on the RSI doesn't necessarily always mean that we're going to crash, but it does mean that when there's a spark, it's a lot harder for it to hold up, especially the institutions are going, hey, should I buy a ton right here when this thing is happening? Is this a good price for me to be paying given that? And it's usually not. So that's when I start hedging up. And, you know, there was a number of things that have been weak in general, even though the market has been going up. But for me, bearish divergence like this, when you have an epic run, are two factors that I'm looking at. And then also, if we go ahead and we look at the 10-year yield, this is breaking above 4.5 again, which is just something that I'm always watching and almost looks like it wants to break out in general higher. And I think this is where we're going to have some intervention happen, because if we do go up, I think the market is going to pull back. And we are pulling back overnight. So it is starting to fall considerably. Let's see, where did we close? We closed at 754. We're now down to 750. And so something I like to check on too also is the length of the move for today from the top. So it's only 1.18%. It's not the end of the world there, and it does make sense. And we're hitting a regression channel here on the 30-minute. And I could talk about that later, but I wouldn't be surprised if we pull back to 740 at least. And it may not be all in one move. So anyway, that's how I'm dealing with the bearish sentiment. I am hedged up on a few things. I have stocks S because I'm hedging against the lead bull, essentially. And that is something I can hold for a long time instead of options. Even though it does have volatility drag, it doesn't have theta decay in the same way. I could hold that as long as I need to hold it. So I do like that because I do think there will be some kind of reversion to the mean. I'll get a pop and it'll work out well for me. And if it doesn't, that's okay. I've allocated a normal amount of capital to it. And the other thing was I am hedging on SPY. And the great thing about hedges like this, I'm 135 days out and I'm paying 9 cents a day for it. And I got a really good price. I actually think it's probably starting to be profitable by this point. Let's see when I actually grab this bad boy over here. I got to go by symbol. Why are we not seeing that there? Oh, I see. I don't see. I am easily missing this. There we go. Sorry, everybody, for wasting your time on that. Yeah, so we're up just a little bit on that, and that's just over the course of the day. And I bought this 2 days ago, so it's starting to work out for me. But the thing that I really like, I bought it 2 days ago over here, probably towards the high, probably as we hit approached 760. Maybe I even did buy it at the high. Anyway, this is that trend line I was looking at against the bearish divergence. So these are always good when you see these bearish divergence. Actually draw in your trend lines to see what's going on. It gives you some of the better entries. It can also help invalidate your thesis. But the great thing that I like about hedging on SPY with SPY puts, and a lot of people don't like doing this because you're overpaying for theta, is going out quite significantly. Because I have a thesis for the full year and I could do a video about that. But my thesis essentially is that in a midterm year, you wouldn't continue going parabolic like this. If you want to call this parabolic, I mean, if we look at it on the weekly, if you look at it on the weekly, even more so, we're starting to look a bit toppy there. You can't see the divergence and you tend not to see those divergences on the weekly. That's barely one here. Although eventually it did. That's the thing. These can run. And to be honest with you, when I hedge on SPY, I generally close it too early because I don't play SPY short. That's not really my move. So a lot of the other hedging that I'm doing in market sentiment like this is not taking big positions. And it's also about taking profits on certain positions. You know, taking a hedge isn't just shorting the market. It's, there's another type of hedging that I don't want to confuse, but you guys know I run Alpha Harmonic Trade OS, and a lot of that program is about architecting a trade using factor residualization, and you will hedge out certain things, meaning if I wanted to trade, I've talked about this before, if I wanted to trade hood because I think it's going to blast, but I also think the market, I don't want to be exposed to market factors. I might go short SPY, a certain ratio that I've determined by modeling out how related the two are. And so, I do a lot of hedging that has to do with that. And maybe I'll up those hedge factors if I think, well, I still think Hood's going to outperform here. And it's true because there's a trade I want to talk about today, which is Microsoft, that I think will still outperform. And going short the market, or don't even call it going short. I mean, it is technically going short there, but buying, a hedge or getting some negative delta is a much better approach for me personally. So yeah, that's my market sentiment read. I'm sorry if it was a little less structured, but essentially when it's toppy like this, I'm taking profits on things that I've run. I'm taking smaller positions. I'm only taking A+ setups. I am actually buying portfolio insurance essentially. And I do it in a few different ways. Like I said, I have that naked put, or it's not naked put. I didn't sell it with no, it's a single leg put there. And so it's just a long put. I've just gone directly in with that. But I have 135 days. I'm going to monitor that to see when I should cut it, but it is essentially crash insurance for me. But the other way, and the reason I'm reiterating what I have here, is in my other portfolio that is smaller, that's just like a holding accumulation portfolio, I have a spread. So it's less on that. And the way that this was structured, it's changed since I put it on, is I generally go maybe 37 deltas on the long leg, and on the short leg, I'll go 15 or 20. Now, it really depends because I calculate how much leverage I need. But if we actually look at this here, I don't know that it'll actually let me see this. Activity and positions. Okay. Yeah, because I have... essentially privacy on, but it cost me $5.67 to buy this. And if we look at the width of the trade, I bought the 750 and I sold the 730. So that's a 20 spread, right? There's 20 points there. So technically that could be $2,000, and I purchased it for $5.67. So I can make $1,433 on it if max profit. So if we go below 730, and a number of other factors happen, we could make that. But that's basically 3 to 1. So I like that a whole lot. That's the kind of hedging that I'm doing. And I can do a whole thing about hedging. I feel like maybe it would have helped a lot sooner than right now, but I did mention in yesterday's video, and I think some of the viewers called it out, that we're looking very toppy right now and we're overbought. And that's a great thing to think about. Remember, SPY can be overbought for a very long time. I would say it's been doing that since we initially broke out, to be honest. So that's not enough of a signal for me, although some people would have caught it here. I wouldn't have caught it with this methodology. But again, I was probably going a lot lighter once we already made this big move. I don't play the actual breakout always. But anyway, moving on to major stock stories. I know this video is getting long, but that's how I do it. So maybe I'll keep those short for today. So MRVL is still one of the most important names on the screen, although I don't love this blow off top on a red there. I had a monster move yesterday. We talked about all of that. I wonder how that's doing in after hours. It's probably going to start filling in some of that gap. Yes, it is. So if we go back to the daily, what are we at now? 282 was the low of this move. And if we look at the daily, 282, right around here. Yeah, so I filled that in. That makes total sense. HPE, as we were talking about yesterday, again, these aren't stocks I'm actually trading. I think that the semi is an overblown trade at this point. That's not how I trade. I'm not telling anybody what to do. I wouldn't do that, but I'm telling you how I do it. So it pulled back after that move, but fundamentally that catalyst was pretty important. The company had those record Q2 results and raised guidance. So I'm not treating it as the last leg of the rally, but I think some other things may start to indicate the last leg of the rally. AVGO is something really important to watch, but it's only down as far as it was 3 days ago. So this isn't the kind of wipeout move that you see sometimes, but it could be the start of it. It's definitely one that's going to matter a whole lot more. So AVGO is tied directly into the custom AI chips and networking for the hyperscalers. So if AVG I'll just call it Broadcom, confirms strong AI demand, it can support the whole infrastructure trade. If it disappoints, though, that really can pressure, SOX, SMH, and the broader AI complex. And that's the main thing holding up the market right now. So I'm watching that. And then also, NVIDIA, I I don't know why that's not loading. It was down today. It was down 3.62% while SOX was tearing. So that tells you something. Essentially it's the king of the AI trade, but the fact that SMH held up better tells me that money might be rotating away from the obvious AI winner into the second layer infrastructure names. But now that SOX looks like it's starting to, again, I go to SOX, so I guess go to SMH overnight, it's starting to have a bit of a pullback. And I mean, these are big notional moves. So if you're holding options, it can feel like a lot. So that's going to matter a lot, because I think people are levered up. From other research that I've done, there's a lot of leverage going on. In fact, even if you just look at how much Soxel is run, and if you saw all of the call buying that I showed you, we can just from that insinuate that people are levered. So these types of large dollar moves do make a difference. I know people think in percentages, but just think about market mechanics for a second. And so that kind of move with AVGO can make a very big difference, and that kind of move with NVIDIA can make a really big difference, because NVIDIA is probably the thing that has to stabilize this, and I think it might. We had a breakout, retest, overshot a little bit. It's probably going to pin there for a while. In fact, we could check out the GEX. The GEX is sometimes a little more disappointing in after hours for a number of reasons, but it also takes a little bit longer for my custom code to pull all the data that it needs from my API servers. And then do the calculation. So this could take a moment, but there was a time back here I was long NVIDIA, short SOX, and that was because, again, I was doing factor isolation, and it actually did outperform in the percentages that I had. Okay, so this is an interesting trade. I think that just means that we're going to be down here for a little bit, but next week and in the future, we'll probably recover. And that's going to go into a trade that I want to talk about shortly, which is Microsoft. So I'm going to save that because Microsoft is the featured trade of the day. And let's go. So we're going to skip that. We're going to Meta. Meta had a great recovery today. It's important because after that recent sell-off, I found more context around that move that I talked about yesterday about, the regulatory pressure from Europe and the UK and all of that insider selling and that reduced institutional exposure. But I'm not really super concerned with it. I mean, it could be the start of a downtrend here, in the local, but I also think this is just more accumulation in the long term. I mean, if we think about this in terms of, like a year now, we really have been deviating around, what is that? I'm going to call it 620, something like that. And if you look at the actual GEX again, that is consistent with it, but I do think we're going to break out of this trend sooner or later. I'm seeing inverse head and shoulders going on here, and I'm also seeing it on like smaller time frames as well. So yeah, Meta still looks good to me. I'm in that trade for sure. GOOG was weak. The AI infrastructure spend and the capital raise, the same thing that killed it before. It has fallen out of a daily trend, so it's something I'm watching, but it's the name I've been out of for a while. I do, and again, when I say out of, I have multiple portfolios. Sometimes I have long-term holdings, and other times I have swing trades. I'm usually talking about swing trades. But again, this isn't financial advice, it's just my portfolio. So it shouldn't matter to you guys too much. Just take the information that I'm bringing to you, including the featured trades that I'm going to start doing. And so Amazon was also weak. It lines up with XLY underperforming, and the market wasn't rewarding discretionary mega cap today. Now is something we've been watching very closely. It got hit hard, but again, this is reasonable for me. If we look in the after hours, I think that this is falling further, but we're still way above that breakout. So this doesn't really concern me too much. My thesis is playing out, but it's actually consistent with IGV. So if you look at IGV, a number of these stocks are following it. That's following it. I started a position today on SAP, same kind of pattern there, but I think they're following the broader AGV and Microsoft. And I think semis falling today might actually, in the after hours, may really help that, but we'll see. That's some cross asset analysis I'm going to have to do this evening. SPCE, like I had told people, it may be something worth, being careful around, or at least taking profits as you go. It is kind of playing out that the $3 cash secured puts might be really nice. You can still get $25 on them 44 days out. So if you actually believe in this, that's how I would play it. I don't know if I actually believe in it for the long run. I'm not sure I need to have this space exposure. But if I wanted to hold something for a long time, that's how I would get into it. The analysis isn't compelling to me at this moment. Like I mentioned yesterday, they still have that short squeeze trade that happened the other day. Oops, I'm back in that. all I wanted to do was go to a smaller time frame here. But when it rips and reverses violently like that, and that dilution issue, that concern that happened, I just don't always think of it as a chart pullback ready to blast off again. I think about it as a narrative that got all muddled in here. And so I'll have to reassess. But that being said, if you are a day trader, you need volatility. And if you identified this volatility here, that's really great. But it's not the worst trade in the world if you want to just play it as a meme stock right here. Great. And then so the rest of the space trade, ASTS was down a lot, 8.8%. Voyager was down about 10%. NASA was down about 6.75%, which is less of a notional move on this. That's the only one I'm interested in at the moment, just so that I'm not playing individual name volatility while we're all waiting for this SpaceX situation to happen. Hood was down sharply. It was down 6%. I had mentioned to you all that I was swing trading that, but luckily I got off on the huge pop because I play catalysts when I'm levered up on options. But it is coming back down to one of my alerts. In fact, I think it crossed it overnight there. So I am looking at this in the longer term, but it's a factor isolation trade. I think it's going to outperform other broker dealers. So that's an interesting one to play. Bitcoin, BTC, IBIT, I mean, they just took a bath today, right? This is the risk appetite warning to me. And I think we're seeing it play out in stocks in a delay, really. And so Hood also is related to that, although in my trade, I will be isolating for that. MSTR also, oh, sorry, that's Microsoft. My fingers just want to do that. So, the speculative side of the market is falling for sure. KWEB had a bit of a pullback today. Didn't kill the thesis, but we are running into the point of control on the weekly. That's something to look at. I'm always looking at that on the daily. It's roughly the same. So if we cross above that, I'm looking for this island reversal where everybody down here either got it right or got it wrong. But not sure. KWEB is a long-term hold for me. So I just wanted to clarify that. But it's the same risk there was yesterday, U.S.-China headlines, tariffs, and whether this is actually a bounce or a regime shift. But time will tell on that. And so let's talk about what to watch for tomorrow. So I'm watching three things. First, jobless claims and productivity. So jobless claims tells us whether labor is starting to crack. Productivity and unit labor costs matter, because they feed directly into inflation and the margin story. So, and then second is that AVGO Broadcom reaction and how it affects the entire market. When I am hedging, I'm looking at the lead bull, and the lead bull taking a bit of a dive is going to kill the market, especially as we identified the breadth hasn't been the best in the last few days. I've seen some YouTubers saying that it's been fine. Show me where it's weak. And I can show you lots of places where it's weak, where they haven't reclaimed the 200 SMA on the daily. So it's and also, again, if we're looking at the correlation between things, IWM and SPY just in the last 2 days is started to shift a little bit there. But it's not terrible. It's not the worst breadth I've ever seen. So, but when the lead bull is holding the entire market up like that, it's an interesting question of how you're going to hedge that. So I'm watching AVG. In short, I'm watching AVGO's reaction tomorrow, and third, Friday is the big one, right? So I'm positioning for that. That's a big move. The market wants a soft landing number, not too hot, not too cold. So too hot means rates push back against growth, and too cold means recession fears start to creep in. So the sweet spot is still a labor market that is slowing but not breaking. So we need to watch that and see how far we've fallen if some of these RSI signals cool off a little bit. But I am expecting multiple days of red, but I'm not shorting it. I'm just hedged in case that happens. I don't tend to short the index like that unless I'm playing futures, which is a totally different video. And I do engage in that overnight to mitigate some of my risk or for opportunistic trades. And so let's talk about an individual trade. So I put out a short today. I haven't really done too many of those, but this is a trade I'm watching, and I'm watching it for a number of reasons, okay? So the first is from a technical reason. On the daily here, we have this inverse head and shoulders that I've been watching for a long time, and it's two things to me. It's also Wyckofian or Wyckoff related. I'm seeing it as an accumulation zone with a spring below, and I finally saw a sign of strength here, or at least a change of character. because we haven't seen this before during this accumulation, but we saw it back here. So we either come back down into this range and that won't break my thesis, or what happened was we filled in the gaps that were left by these overnight blasters, and then we shook out some of the people who were YOLOing after it, especially right when it crossed the 200. And I expected to come back up into the 200, and this was a good place to get it into. You know, I have some long-term shares, what you're seeing here, but I was playing this with options. And so since this is a trade idea, I'm actually going to tell you how I've personally taken this trade. I have gone in on a number of things. So let me switch over to a different portfolio because I do it across different portfolios sometimes. And I play it differently. Like that was a long-term holding. I'm just adding shares when it's opportunistic to do it. But let's look at, say, this portfolio, which is, let me get to it, which is essentially just swing trading this position. You can see I don't have any shares on it. I'm doing two things. So I'm building up a position MSFU because I can hold that for a longer term because I have a year-long thesis for this, which is that if you look at Microsoft, we're going to get back up to the $500 mark at this point of control. And we may not, but MSFU, as opposed to options, I can trade overnight. It's EXTO eligible, and I can hold it as long as I need to. All that happens is maybe volatility drag, or I'm incorrect and the value of it goes down. But this is a position I want to be building out. Again, do your own diligence on this product and how you want to trade Microsoft. I'm just telling you how I do it. The other thing that I've done is when I analyze the GEX, because something appeared to me that I love to trade, and I do this all the time. But again, the technicals are set up, and I've talked about the instrument. Maybe I'm getting ahead of myself, so let me go through this trade one more time. Look at the technicals. The technicals look good. A Wyckovian accumulation, a spring, and a change of character or a show of strength or sign of strength. Here, but either way, a breakout retest, filling the gaps and keeping the super trend. So a lot of confluences here for me that I really enjoy. And we're not oversold at the moment on the daily. We were momentarily, which makes a whole lot of sense for me. But what I want to show you is the GEX. So here I have this near-term expiration, which is just the end of this week. And then here I have the end of the month expiration. And this is very important as you come into a month. Later in the month, sometimes they just actually mirror each other, and I'll have to push this out to a different month. And then here's the total gamma for the year. I think I have a thesis that SaaSpocalypse, or just the devaluation of software because of AI, is fundamentally incorrect. You can agree with that or disagree with that, but that is the assumption that I have going into this. And then I'm looking for the actual technical factors to get into it. I just told you the charting factors. That makes sense. But then GEX, it's a technical factor for sure, or flows, but it doesn't show up on everybody's chart. What I'm seeing here is that right now we're pinned to 427 on the near term. And earlier today, this was pinned at 425 in the short that I made. But the rest of the month, we're seeing a ton of GEX above that. And let me go ahead and zoom in a little bit here so you can see what is going on. We have a ton of positive GEX going all the way up to 450 right here is this biggest, 440 is this big, or actually is that 437 right there. It doesn't quite matter because the target I'm actually looking on is the overall GEX over here, which this is the 450. And to me, that actually does make a lot of sense on the daily here. The 450 is not very far away. It's the slightly above the 200 SMA, but it's also one of these fibs that I've marked out. So again, a lot of confluences here, and getting back up to 450 isn't a huge stretch. It's not even the peak that we saw 2 days ago. So I am actually okay with that as my initial target. So the way that I'm playing that is I have options to target that. And you can see I've gone out over to 107 DTE, slightly out of the money for the 440. And I got good prices on these. The leverage was good on these. And if you guys ever want to talk about leverage calculations for options, that's a huge topic. I have a tool that helps me find some of those. I can even just show you that tool very quickly here. So Opridge Leverage Scanner. This is a big one, and I can go out and I'm looking for options on Microsoft, and I want my DTE to be at least 100, and I'm going to run a scan on that. It's probably going to find a lot of stuff that is yeah, okay, so 430, and I'm getting adequate leverage here. I'm getting 5 times my leverage, and I can go through how that works. They're structural and effective. And so I go through that and try to find some of the best strikes that I can, given the capital that I want to allocate towards it. So the trade also has another part of it. So this is a 3, you can get a sense of how deep I go with this when I put in a real trade, because I may be holding on to this for a little while. And so the first part, as I said, was MSFU, and this is just to build a core underlying position that I can add to overnight as moves happen. This is more of a day trade / DCA into my thesis. And it also allows me to cut things as I go and to add things as I go. The only problem is that the way Schwab calculates it is sometimes this is not reflective of what it is, because if you're adding and selling, it doesn't know how to calculate the first in, first out, last in, last out situation unless you set certain things. But that's for a different YouTube video. So that's the first part of the trade. The second part of the trade was actually to accumulate some long calls slightly out of the money based on leverage and a target price that you're looking for, and also to have an entrance and exit plan for those. I don't just buy these. I put a buy order where I'm looking to get a limit order. And I got filled today, and then it kept falling. So it did hurt a little bit, but I was okay with getting it where I got it. And also those prices tend to be exaggerated sometimes as it's falling. So that can be a good thing depending on how you're getting in. The third part of the trade is that I do want to own this if we fall, because a lot of times what happens is you have this great trade plan, it goes against you, and you don't get it, but you may have wanted it down here. And one of the ways that I handle that is with cash secured puts in a different account that I may transfer over to long-term holdings sometimes. And I don't want to get into tax issues with wash sales, which, they're not a problem. You just have to be aware of how you're doing it. But this is for accumulating long-term shares. And sometimes I use it to fund the call options that I'm buying. But essentially, I sold cash secured puts on that same expiration in one account and a different expiration in a different account. In this account, I sold the 360, because this was a big 2 days of falling on Microsoft, right? So after a move like this, these premiums are inflated from where they were 2 days ago. And if you don't believe me, just go back into the time machine to actually see that stuff, or on demand, whatever you want to call it. It's hard to get options prices otherwise, historic option prices. Some other platforms do it. But these are way inflated from where they were. And I sold 2 of those. And so I got roughly, what did I sell them for? I sold them for $10, so that's $2,000. And as you saw, one of my, if I go back to a different account here, one of my call options was, $2,500. So, or 20, what was it when I bought it? 3,000. It starts to help fund this endeavor. And the way that I'm managing this is essentially what people would call a wheel, but I'm not entirely sure. I'm doing it to be assigned. Basically, I'm saying I'm okay getting assigned down at $360, but I won't get assigned there. I'll get the break even for what I paid is another $10 below that. So I probably won't get assigned unless it hits $350. And so me getting Microsoft for $350 would be the lows of when the Iran war started happening, essentially. When the Iran war started to have a peace treaty or a ceasefire going. So the actual lows of the year. I'm willing to buy Microsoft for that price when I thought it was way oversold, and when I also thought that the thesis was wrong, and when the market was facing one of its biggest challenges of the year. So for me, that's a great place to get it. But because these are cash secured puts in an account where my mandate is to sell cash secured puts to collect income, and if I get assigned, I want to be assigned. What's going to happen is I either get assigned there over some crazy move that would probably indicate to me I want to own Microsoft at this point, or more likely, if my thesis plays out, this is going to slightly recover and maybe not go to the moon, but as soon as I have profits on these that are reasonable, I usually cut it at 25% or 30%, depending on how long it takes to get there. I'll have made a profit on that leg of the trade. So that's the feature trade for the day. It's Microsoft, and it's based on a read of technicals, a variance perception where essentially I think the market has incorrectly thought about this company and how big of a player they're going to be in AI and software. So think about that for a second. Their fundamentals, which I still think are great. And then also the GEX picture is telling me that when some of this negative GEX rolls off this week, we might be looking a lot better. Yeah, so to wrap up, thanks everybody. I hope this format was a little bit better. Please let me know. I know it was still fractured. I'm trying not to spend all my time planning the video, but to actually show you how I'm looking at a chart. Let me know if you'd like them to be tighter. Let me know if you'd like me to go through anything differently. Yeah, let me know. 15, 25 minutes video is better to you, or do you actually like spending an hour with this just playing in the background? I know I used to listen to a lot of YouTube videos because when I was away from trading, I wanted to hear other people's rundowns. And so sometimes I liked when the video was an hour. You can put it on double speed if you want, or you can come back to it later. There's always more to listen to. So thanks. Please put some comments, and hopefully this trade worked out for me. I can't say how it's going to work out for you. This isn't financial advice. This is for educational purposes only. But be safe in the markets, everybody. I can at least say that part. And thanks for watching.